Good afternoon, ladies and gentlemen. A very warm welcome back to all of you on Business Today Television in our ongoing coverage of the weekly expiry of the Nifty today morning. We have seen some kind of respite coming in on the back of short covering, on the back of value buying in many indices. For the record, the Nifty Bank is in the green now, 77 points higher. If you remember, the intraday low of the Bank Nifty was somewhere in the vicinity of 58,800, so a very sharp recovery from there. The Nifty itself has recovered substantially from a low of 25,750 all the way up to 25,900 for you. That's the recovery that's coming in, and in the green, ladies and gentlemen, are the mid cap and the small cap indices, which are recovering from multi-month lows. To discuss this and a lot more as far as where the markets are headed, we are now joined by Mr. Amit Goel, co-founder and Chief Global Strategist at Pace 360. Namaste Amitji, and a very warm welcome. Turbulent times on Dalal Street. Macro numbers are good. GDP showing a 6-quarter high. Another rate cut by the Reserve Bank of India, but the markets just refuse to come out of their depression. What do you think is ailing Dalal Street?
Firstly, Shell, thank you for having me on. And yes, you're right. It's been very turbulent, and many of the investors who had, even when in February and March we were going down a lot on the Indian markets, they still kept a lot of patience because
Yes.
there was a lot of hope that this correction is going to be over at some point and the good times will roll in again. But I think the structure of this rally of the last 6 months, where of course Nifty rallied, small caps and mid caps initially rallied in the first couple of months, but they have been very weak, and the price action has been pretty destructive in the last couple of months. So that has, I think, unnerved investors more than the very sharp correction earlier this year in March and April of 25. So it's been a lot of trouble and a lot of let's say rethinking by investors whether this is for real, and whether small caps and mid caps and the broader markets will come out of this morass or not. So a lot of soul searching, a lot of thinking going on. And I agree with you. There have been some green shoots in the last couple of hours where small cap, mid cap, and bank Nifty, they have come into green from red. Nifty is still in the red. So this is actually a good sign, in my opinion, for the very near future, that Nifty for a change is underperforming the small cap and mid cap. So this is, I would say, there are a few green shoots now which probably point out that small caps and mid caps, after this gloom and doom and after this battering that they have received in the last few weeks and the last couple of months, probably, at least for now, they may have bottomed out.
Okay. Amitji, I think you very rightly have encapsulated the disappointment that small cap and mid cap investors have faced. Those in funds are still shielded because they have the expertise of the fund manager to navigate this volatility and this sell-off. But those who have bought shares on their own based on their own research, or God forbid some tip or something, have had terrible times on the Dalal Street. What is your prognosis on the small cap and the mid cap index? Is the best behind us?
I would tend to agree with that statement, unfortunately, Shell, that the best is probably behind us. The heady days of 2024, where literally everything was going up. People used to say that if you choose a bad stock, it will go up by 20%, but if you choose a good stock, it will probably double or triple. So we've seen those heady days, and in any normal bull cycle, you don't get that many times over. So those heady days are probably over, but at the same time, uh, I would say that there would be times when the market would present us with some value opportunities. It would not be an across the board opportunity. I'm absolutely sure about it that the index as such, the small cap index, the mid cap index, whether they are NSE indices or BSE indices, on the whole are still not looking very attractive, Shell. But there would be pockets of value from time to time. So one would have to go a little stock specific than go by the index. And but longer term, frankly, I hate to say that, but I'm pessimistic because it's not just about the Indian market. Sometimes we are so we are so engrossed with what's going on in the Indian market that we often tend to feel that it's like an island, and irrespective of what happens to the world, Indian market will do what it has to do. But unfortunately, the global headwinds are now piling up, and my sense is that 2026 calendar year is not looking, the signs are ominous. It's not looking like a great year for the global markets. For the Indian market, my hope is that the runway is a little longer, because last few months we have underperformed miserably because of the fact that South Korea and Taiwan and Chinese technology stocks were getting all the money flows and they were getting all the action. So my sense is that the runway for the Indian stocks is a little longer, even when the AI bubble bursts. But the longer term picture is still not looking that great.
Okay. Um, while of course these global headwinds are there and have been there for a while, Amitji, we've had a lot of positive developments in India over the last 15 days or so. A very strong number coming in from select auto companies in terms of monthly sales, in terms of quarterly results. The GDP grew astonishingly fast, 8.2%, best in 6 quarters, and of course, this unexpected rate cut. But somehow, more than bulls, it's the bears who are taking advantage of this. What could be possibly wrong with the system here?
Shall we all uh, know a few things about the Indian market. The fact that because of this huge surge of domestic flows, some of the smarter players are getting very easy exits in the Indian market at valuations which are just completely out of whack from the rest of the world. So you could get a FMCG company here in India trading at a 50, 60 P valuation, and the same company's global holding company, or the main company in US or somewhere in Europe might be trading at a P ratio of 15, 18 or whatever. So same is true for consumer durables, same is true for uh, auto companies, so on and so forth. So I think uh, Indian market, even now, after this massive underperformance of the last 1 year, is still not undervalued by any stretch. While the indices may appear as if they are in line with the 5 year average or close to their 10-year average, but fact of the matter is that those indices, the P ratios have come down because of some sectors trading at very, very low valuations, like OMC and banking and so on and so forth, and maybe some of the metals. But the broader market is not at all cheaply valued. So this is one issue. Then, of course, the spate of IPOs, which is actually taking a lot of money from the mutual funds and from institutions, because of which the institutions are not able to put that much money into the secondary market. So there are a lot of issues. But I would also want to say something which is a little different from what everybody is talking about, and that is the fact that uh, let's be very clear, the markets are very, very forward looking. I would want to point out that last year in August and September, our GDP numbers were not looking great. We were at 6% or below at that time, and the government expenditure had fallen. Our consumer durables were, they were like a pain point. Auto sales were going nowhere, and RBI still did not have the luxury of being dovish. RBI was a little hawkish. But in spite of that, the Indian markets were making new all-time highs, and Indian markets were outperforming every major market of the world till last year September. And now, cut back to the current time where everything seems to be positive, whether it is the GST reforms or the tax cuts or the RBI being dovish or the interest rate cuts or the great numbers from autos, consumer durables, earnings looking better, and the Indian market is in a bad shape. So markets are forward looking. Markets had the wisdom last year of starting to come down at a time when the GDP was picking up because the markets were probably realizing that they are overvalued. So I think markets being forward looking is a very important aspect of what's going on. And beyond, and let's say these GST numbers, if we talk about the GST cuts and everything, the best part of the best part of the consumer and auto resurgence is probably going to be over by December or January, Shell. So markets are forward looking and they know that beyond that point, the sales are going to start plateauing once again. So there are a lot of factors which go into how the market is constructed today. But it's just that I think the market still has some value opportunities. It may not be an across the board opportunity right now, but I think there would still be some value opportunities in this market.
Okay. Fair point. That's been quite a discussion on the broader health of the market or its lack. Amitji, let's look at what Pace 360's personal prop money is up to. Now, share with us the allocation structure for equities and other assets to begin with.
So, Shail, we last time when we spoke, we were kind of optimistic on the market, and we were the Nifty was going up. The small caps and mid caps were still not doing well at all at that time. And at that time, we were buying Nifty ETFs, and we had bought a few stocks like Reliance, and we had bought banking, for example. We were basically playing this cycle because it was our assumption that at least Nifty will make its new all-time high, and Bank Nifty in any case was at an all-time high at that point, and it went on to make higher highs. As of now, we are sitting very, very conservative in our portfolio because as of last week, we literally dumped all the ETFs that we had bought, and at Nifty levels of about 26,170 to 26,200, we have literally dumped everything. Now our allocation to equities is minuscule. I'm enthused by what has happened in the last few hours, but since my longer term picture is still not good, and I still think that 2026 globally is going to be a forgettable year for global equities, and in which case Indian equities, in spite of the fact that they will find some buying because of the fact that the anti-AI trade, once AI starts to go down, then some of that money will flow back to India. So I don't think Indian market is going down over the next few months, but I also feel that the upsides are very limited. So I'm not downright bearish for the next few months at least. I think it's largely a sideways market, but longer term, the picture is not looking great. And I think Nifty was almost destined to make a new all-time high. I would have hoped that Nifty goes all the way to 26,700, 800, and that was my assumption. But something was amiss. We felt something was amiss last week, which we got out of equities, and now we are almost entirely into debt. We are into corporate bonds, and this entire portfolio is giving us something like a 11% yield right now. We are happy with that yield right now, and we will probably dip our toe again into equities some point in the next few days. But right now, we just thought that it is better to be safe than to play aggressive in this market.
Okay, fair point. A view on gold and silver? Have you any allocations on them presently? Have those allocations moved up or down?
So we have some allocations to sovereign gold bonds, which is not a big percentage exposure of the total. So those we would hold on till maturity. We don't have any silver exposure as of now. And again, while we have been, some of the oldest proponents of gold way back in 2019, when gold was literally one of the most considered, one of the most boring asset classes in the world. That was the time when we took a lot of exposure on gold, and but right now we are not so enthusiastic either about gold or about silver, because of the fact that the price action of the last few months and the way the money has gone into ETFs and the way the whole world is talking about gold and silver as if the entire world's equity money and bond money is going to go into gold and silver. I do not think that anything like that is going to happen. And I feel that this time when equities go down, chances are that gold and silver will go down with them, and they will not be a haven trade anymore. And you saw shades of that, Shell, a few weeks back when Nasdaq went down to 23,800, which was precisely 21st of November, Shell, and all the world markets were bleeding at that time, and gold and silver also went down, and particularly silver had come down to less than $49 an ounce. Today it is still at $58 an ounce plus. So my sense is that gold and silver are no longer haven trades, and whenever equity markets go down in 2026, gold and silver will go down with them, which is why we have such a little exposure to gold and we literally have zero exposure to silver.
Okay, on that very somber note, let's pause, Amit ji, and then wait for the markets to respond the way we presume they should, or the way they will, and then we'll accept it. Markets have a way of surprising on the short side and on the long side, and we've lived with this for the last 3 decades or so, and they won't change their attitude. It is only us who has to adjust to the new reality. With those thoughts, Amit ji, thank you for your time, and we hope to see you soon, fairly shortly.
Thank you so much, Shah. Thank you.
This, ladies and gentlemen, was Mr. Amit Goel, Chief Global Strategist and co-founder at Pace 360. Well, the Nifty is still battling 25,850 between the bulls and the bears. The green tick on the Nifty bank is just that, a light shade of green, but not exactly the great expiry that we were hoping to pan out. Nevertheless, we've seen really bad days early morning. They have improved for the better. Please continue watching Business Day Television. There's a lot that's happening on the other side of the break.